We're standing on the edge of something big, and we're gonna make some changes. We're gonna make some changes.
Hi, I'm pleased to announce something very special to me, a new subscription-based service through NextAct Advisors that allows members exclusive access to personal industry insights and bespoke corporate governance knowledge. This comes in the form of blogs, personal book recommendations, and early access to the Founders Sandbox podcast episodes before they release to the public. If you want more white glove information on building your startup with information like what was in today's episode, sign up at the link in the show notes to enjoy being a special member of NextAct Advisors. As a thank you to Founders Sandbox listeners, you can use code SANDBOX25 at checkout to enjoy 25% off your membership costs. Thank you. Welcome back to the Founders Sandbox. I am Brenda McCabe, your host, now into its third season. The monthly podcast reaches entrepreneurs and business owners who learn about building resilient, scalable, and sustainable businesses with great corporate governance. I like to assist, and my mission is very simple, entrepreneurs in building those scalable, well-governed, and resilient businesses. And the guests to the podcast are also founders, business owners, investors, professional service providers who, like me, want to use the power of the enterprise, small, medium, or large, to affect change in the world. Through storytelling with each one of my guests on topics that are going to touch on resilience, purpose-driven enterprises, and sustainable growth, my goal is to provide a fun sandbox environment where we can equip one startup founder at a time to build a better world through great corporate governance. Today, I'm absolutely delighted to have as my guest, Martin Tobias. Martin,
hello.
Thank you for joining me. Yeah, you're
Thanks
joining. You wear many hats.
Yeah.
I've been a follower of yours for years. We're both in the enterprise SaaS space. You're joining the podcast today. We have a full load of questions here, but as managing partner of and founder of Incisive Ventures, and there's a lot to unpack here. You defined it as an early stage venture capital firm focused on investing in the first institutional round of technology companies that reduce friction at scale.
Yeah.
So we're going to get into what does that actually mean for my listeners. And you're also a blogger at Incisive Ventures, right?
Yeah, and a personal blog as well, and fairly active on Twitter.
Excellent.
I always appreciate the connections I make on Twitter. And when I go to real life events too, I was at a conference last week and like 20 people walked up to me and said, I follow you on Twitter and I wanted to say hi. And I'm like, this is amazing.
Isn't it amazing what digital footprint can do? And it was, I've known you for years, and it wasn't until I subscribed to your blog at Incisive Ventures. And it was in June or July this year, one of your blog posts really resonated with me. And that's the title of the episode. I always have a title called around resilient, sustainable, or scalable, and purpose-driven. It's a resilience, why starting a company today is awesome. That was the title of this blog. And I thought, what a better time than now to have you as a guest, because it's a tough market out there. Yeah. And your own experiences, leaving corporate life and then having your first startup, and then as a CEO, founder, building, scaling, selling, you've had some ups and downs. Just the hindsight that you can bring, you've been through quite a few economic cycles, as have I, and
all
just bringing
three cycle investor. That's what they call us. Yeah.
So you heard it here, 3 cycle investor.
3 cycle investor.
Excellent. So before I jump into the topic of why starting a company today is awesome, paint a picture of Martin's deep experience. Mm-hmm. He was previously at Accenture and Microsoft, and is a former venture partner at Ignition Partners. Martin is a 3 times venture-funded CEO, raising over 500 million as CEO with 2 IPOs. And you have also invested in hundreds of companies and is a limited partner in over a dozen VC funds. Martin was an early investor in Google, DocuSign, Deal, and over a dozen unicorns. So it's a privilege to have your presence here and your insights. You're also a father of 3 daughters, left one off to med school,
Girl dad.
cyclist, surfer, quintessential California, although you're not from California.
Yeah,
Poker player, life hacker, and
Yeah.
you tinker with motorcycles on the weekends. So
I do.
in the show notes for my listeners, you're going to have multiple points of access, Incisive Ventures, Twitter, as well as Martin's LinkedIn profile. So let's move into the body of my podcast. You and I, our paths have crossed over the years while working and investing in enterprise SaaS companies. Your blog that came out in June 2024 at Incisive Ventures, How I Lost 500 Million and Still Won, Lessons from a CEO and a VC. And I knew that I wanted you on my podcast. So I reached out, and you actually do answer your subscribers immediately.
I do.
You were in Paris, I think.
Yeah.
At a speaking engagement. So walk us through, share for my listeners some of the highlights of your career that led you to become a founder and then a managing partner at a VC fund.
Yeah. Well, one of the things, I mean, some people say it different ways, but one of the sort of advantages of having been a founder and investor for a long time is that I got a lot of arrows in my back, and I've learned a lot of things. And I actually find it interesting because people on Twitter or people in their bios, a lot of times they just talk about all the positive things. But what, frankly, I think sets many people up for future success is what they learned from the negative things that happened in their lives. Because hopefully those were learning experiences. And, that one of where I took my company public and then made and lost a bunch of money, that's been a really formative experience for me about how to invest, going forward and understanding where you are in the cycle. And the learning for me on that was, what I say about bubbles, first of all, it's better to be in them than out of them, but it's also, you need to be aware of, are you in a bubble? Loud Eye Technologies, which I started in 97 and we took public in 2000, we were, it turns out, the absolute last company to go public in the dot-com boom. Here's a company with $10 million in revenue that got a $2 billion market cap for a $10 million revenue company. I knew as a CEO that we were in a bubble. I knew the bubble was likely bursting. I was trying to get that fucking company public before the bubble burst. And it turns out we went public March 17th. The peak of the NASDAQ was March 21st. We were literally the last company to go public in the dot-com boom. So when you realize you're in a bubble, first of all, try to take advantage of the bubble if you're a founder. If you're in a category where people are throwing money around, take the money. But don't believe your own hype. And don't go spend the money like we've seen some people do in crypto or some other enterprise software companies where they continue donking off the money. What we did at Loud Eye, we realized we were in a bubble. We were lucky to get the company public. We have $110 million cash sitting on the balance sheet. And then the market goes to shit, literally 4 days after we go public. So what do? Do you keep spending, this huge burn rate and trying to sell and trying to get customers and all that stuff? Or do you sort of turtle and sort of change strategy and, preserve your cash? We ended up doing the latter, but we were able to do that. The reaction time to a lot of founders to when bad things happen, and you saw this, when the retrenchment happened, like in the pandemic.
Yes.
A lot of VCs were sending out stuff to their CEOs like, hey, cut the burn really fast. And, it's hard to cut the burn in those scenarios, but, survival's the name of the game. But anyway, so that company, it's worth $2 billion at the IPO. A year later, it was worth about $200 million. So down 99%, like every dot-com company was.
We've all have scars in our bodies from that time.
A lot of people have scars.
Yeah.
I mean, don't feel bad for me. I was fine. But one of the learnings that because I had kind of knew that we were in a bubble, one of the things that happened, at the IPO, I owned about 30% of the company.
Okay.
So
Not
I
bad.
had more than $500 million of stock, but I did not change my life. I didn't buy a new house. I didn't buy a new car. Um, I did nothing different. It's just a number on a spreadsheet.
Okay.
I knew a lot of people that did that. I have a friend whose company went public during the dot-com boom. He was the COO of this e-commerce software company. His software was worth $120 million when it went public. And the first thing he did is he took a $30 million margin loan from his broker, went to Miami, bought a mansion, got a Ferrari, and started living like he was a 100 millionaire. A year later, his stock was down 99%. He gets a margin call. He lost everything.
Yep. Yep.
And I mean, I was aware that we were in a bubble and that the money wasn't real. I mean, and by the way, when you go public and you're the CEO of a public company like that, you can't fucking sell your shares anyway. Got these
Exactly.
trading windows, you've got all these other issues. If you start to sell, there's a negative signal in the market. So you can't count that as real money. So the lesson was, don't believe your own hype. Don't count the money until it's actual money. And just continue to live make the best decisions you can with the information that you have.
I like what you said too, around just being aware that you're in a bubble.
Be aware.
Be
And
aware.
if you are in a bubble, I mean, take advantage of it. I mean, we just ended, probably a year ago, ended probably the largest bull run in venture capital ever. The ZERP period and all of that stuff. Companies could raise with almost any business plan could raise money every 6 months. And we are now over that. We are now in a risk-off environment. And there's a lot of founders out there. I got one last week who's like, the round's closing on Friday. Do you want to can you write a check, in 5 days? And I'm like, what is it? 2021? Are you kidding me? No, I can't. I'm passing. We are in a risk-off environment. And a lot of people still haven't changed their brain to realize that we are in a different environment. And some CEOs are having a problem with it. They're like, hey, I got this crazy valuation in 2021. I've got to get it up. And I'm like, listen, the market changed around you. It's not your fault. Your company still might be good. It might be doing well, but the metrics have changed, and you raise money in the company that you're in. The smartest CEOs that I know now, they take the dilution, they take the down round, they do the hard stuff, they clean up the cap table, they do the hard work because, I mean, I just posted something about this on Twitter yesterday.
Okay.
I've said it a couple of times. As CEO, you have one job. One job. You know what that job is? Don't run out of money.
Don't run out of money. You have a lot.
Don't run out of money.
That's right.
And to do that job, you only have 3 tools. You can sell something, you can cut expenses, or you can raise capital. There's nothing else to do. People talk about your job is culture, your job is this and that. Okay, fine. All those are second order things that you do if the money thing is working. And if you are, if you have less than 6 months of cash in the bank, you have to do some very different things. You have to change your decision.
And going back to Loud Eye, and so did it not sell to Nokia?
Yes, it did.
How did that happen? Play that out.
Well, the business was doing okay. I mean, basically it had $120 million of cash. We cut the burn and we sort of made it through the dot-com bust because we had cash with a smaller team. And then we built some other applications, got some other customers. And basically it was the largest, it had the largest database. We actually ran all of the back office music services for like Amazon. When you listen to 30-second sound samples before buying a song, those servers and all those sound samples were created by Loud Eye. Loud Eye was running digital download back end for some of the early music services. So we had a whole bunch. We were the only company that had all 5 major record labels having legal digital distribution rights through our servers. So what Nokia wanted in the end is they wanted to get into music distribution on their phones. And
Mhm.
so they ended up buying it. So the company had enough money to survive through the dot-com boom and end up selling. It wasn't a great exit relative to the prior market cap in the company. But people got jobs and it turned out okay. Yeah.
While we're on that topic, so I'm going to jump ahead. So Loud Eye was your first startup coming out of,
Loudeye was my first startup coming out of Microsoft. I
right?
left Microsoft on Friday, started Loudeye on Monday.
Wow. And in your LinkedIn profile, you talk about, hey, well, we were early to the market in terms of
Definitely.
technology, right? But I was right. Can
Yeah.
you apply that same kind of logic to what we're seeing in generative AI? Mhm. Smart.
Well, so
Mhm.
so what I say about generative AI, I mean, almost all of these hype cycles that come around, including digital media, which I was a part of, people overestimate the impact in the short term and underestimate the impact in the long term.
Okay.
And that's what creates a bubble. People are like, this is going to change everything. All the valuations, like Loudeye being worth $2 billion, for a $10 million revenue company. That was a bubble. People were overvaluing digital music at that time. But if you look at what's happened to the music industry today, 15 years later, it's all digital.
Absolutely.
There's nothing else. Like nobody buys CDs and tapes. Like it's the way that people consume music. And things like Spotify and Amazon Music and so on are very big
Mhm.
businesses, and it's totally transformed the way people experience music. So I think generative AI is very similar. Like, my um, picture on Twitter was a generative
Ah,
AI
I saw that.
thing, and a lot of people are playing around and trying things out, and people are like, "This is kind of cool." Then the question is, how much would I pay for that, and what's the real value of that in my life? I don't know. So that people, we're in this the positive part of the hype cycle where people are like this could change everything, but they don't really know how it's going to change things in the future. So we are in a AI bubble, but I definitely believe that AI is one of those few major shifts. I wrote a post about that. I mean, there are some fundamental shifts, like mobile was a fundamental shift, mobile first versus the
Mhm.
enterprise.
Mhm.
Cloud versus owning your own data centers, another fundamental shift in the architecture of how people build and deliver things. And AI is one of those kind of impacts.
Yes.
Um, but what it's going to be, I mean, the way I look at it, I think that the major AI companies, the LLMs and the core function is going to be owned by the same people who own the cloud. It's Microsoft, Google, Amazon, Facebook. This is not an opportunity for startups. But if you look, and it's the same thing that happened with the cloud infrastructure. I mean, Azure and AWS, all big businesses. But if you look at the value of the enterprise software companies, which are built on top of the cloud,
Yes.
it's like 20, 30, 40 times more than the infrastructure layer. And we're in the AI build out, we are in the early phases, like we were in the early phases of cloud, where in the early phases of cloud, Dell and Cisco made all the money, the network, the infrastructure guys. But
Yep.
over time, the application people make a lot more money. And
Okay.
that's going to happen in the same in AI, I think. We're in the infrastructure phase where, NVIDIA is getting something like 60 or 70% of the money being
Mhm.
deployed to AI today.
Mhm. Mhm.
But applications that solve people's problems, and generative AI is one that can solve real business problems. For example, doing personalized cold outreach emails at scale is a
Yes.
generative AI thing.
Yep.
That's something
Productivity.
a lot of people want to do that
Mhm.
delivers value to businesses.
Mhm.
There are other generative AI things like these automatic note takers that everybody uses in Zoom calls, automatic to-do list creations, things like that. I think those will have real fundamental impacts into how people work and make their lives easier in the future.
Thank you. So we're still at the infrastructure phase and building
Definitely.
out large language
Yeah.
models, right?
Yeah.
That
Yeah.
at scale. Because I do want to mention, was it who had the big blip? One of their, was it Bard? Their generative AI model came out. There were huge biases in it, and
Yeah.
stock
Google.
went
Yeah.
down $80 billion in one day.
Exactly. Yeah. Google screwed up. We're in the early innings of this. We're in the first inning or something. There's
Yep.
going to be a lot of things that screw up. Um, and but it'll all get fixed. That bias will get fixed. That's just a training problem.
Right. Okay. So in this third season, thank you again for being my second guest on this third season of the
Thank you.
Founder Sandbox. Many of my guests, you're veterans of the corporate world. And became either by purpose, mission, curiosity, or the love of sharing their insights on building resilient companies, get involved in the ecosystem of startups. Your corporate experience was over 10 years between Accenture and Microsoft. Then you went
Microsoft.
off to, as we've heard here, create your first your first startup, Loud. What is it that makes you stay in the game, Martin?
I suck at golf.
You heard it here.
And I'm an ins I I have retired 3 times.
Okay.
After Loudeye went public and I hired another CEO, my daughter, who's 24 now, was 2 at the time.
Okay.
And I had this giant number on my balance sheet, and I didn't buy a new house, but I'm like, well, maybe I'll just stay home. Maybe I'll just be a dad, right? Like I don't have to do anything. So I went from working 80 hours a week to 0. And after about a year, I knew every word of every Teletubbies song, and I hadn't had a conversation with an adult. And it was, I literally was going crazy.
Okay.
Um, and so I said to myself, I love being a dad, but there's got to be more to it than that. I mean, I got to have hard problems to solve. And I had hobbies, like I like to work on my motorcycles and I like to surf, but I had a house in Hawaii. We went to Hawaii. I surfed for like 6 months, and I'm like, I love surf, but I can't surf all the time. Like I'm just bored.
Mhm.
Um, so I went on this about 10-year journey of like, what am I going to do when I grow up? And
Wow.
what have realized personally for me is that I need to have hard problems to solve every day.
Okay.
And I need to be intellectually stimulated. I need to be around other smart people. And being a venture capitalist lets me be curious about a lot of different kinds, because CEOs come in and they're like, I'm going to change this industry. And then I know nothing about that industry. I get to learn something and it's great. But I get to help them with my experience as well, maybe, steer them in a little bit of a better direction or something like that. So it gives me intellectual problems to solve every day,
Mhm.
which keeps me engaged, but it also gives me a little bit of flexibility, not being the CEO who's responsible for all the employees and everything every day.
Right.
So for me, being a VC has turned out to be the perfect work-life balance thing for me.
Thank you. That's um, quite insightful. And I liked how you said, I like being a dad, but I want to be stimulated, solve big problems, be around smart people. And you went on a journey, and that journey has been what, 15 years, 20
Yeah,
years?
about 15 years.
Yeah,
Yeah. I
yeah.
mean, I went back, I tried being a CEO again. I tried being an investor. I tried being an advisor. I tried all different things. And what I've come to is being a VC.
I, I love it. I love it. So you have been CEO,
Yeah.
chairman, and board of director of or board director of companies. And I always go back in the Founder Sandbox. I'm passionate about good corporate governance, and the earlier you start, the
Yeah.
better, right? My background is when I was going to grad school, Enron blew up. I was then at a pharmaceutical company, and we had very unethical behavior, collusion, and it was when Sarbanes-Oxley was born, right? So in the end,
Mhm.
2001. So that has really informed me on working with startups. So my last 15 years has been working with them from ground zero to really have good corporate governance, which is informed decisions that do comply with legal, regulatory, financial, but also just bringing in those advisors, either as advisory board or fiduciary board of directors, surrounding yourself by wise people that have been in the trenches, and you can benefit from that. So I'd like to ask 2 questions because you've been in these roles. Um, what is a CEO's perspective now that you have hindsight, and how to work effectively with the board of directors?
Mhm. Well, let me make a couple of general comments on that. And I appreciate your focus on this sort of governance and stuff like that, because frankly, I think that we have in venture gone off the rails on that with the explosion of late stage capital, the introduction early stage to all safe notes where you don't have priced rounds, you don't have boards of directors. You've basically delayed corporate governance longer and longer, and you can because of all this fucking money.
Right.
And, you've got private companies that go, private for 10, 15, 20 years before they go public. And, Bill Gurley talks about this. There's a certain discipline that's imposed on a company being public. And by the way, growth can happen in public companies. 98% of the enterprise value of Amazon and Microsoft and Google were created after the IPO. And so I think this, and I think one of the worst things that happened in venture in early stage pre-seed and seed is the invention of the safe note, because the safe note is basically not a liability on the balance sheet. It doesn't grant the investors any rights on the board. There's no governance. The CEOs can just collect these things and then run the company any fucking way they want with their friends on the board or whatever. So it again is a tool that enables you to delay putting in correct governance. Now, some CEOs will say, well, I want to do that because I'm just doing my own thing and I don't want to listen to any of these guys. But okay, at some point you're going to have to grow up and be accountable to the shareholders who you took their money. And the fact that you can delay that is not necessarily a good thing. I am a fan of pricing rounds earlier, maybe even a price seed round. I'm a fan of putting a board together earlier rather than later. Maybe after you raise $1 million, you need a board. Some people don't put boards together till the Series A when you're raising 15 or $20 million. I encourage my founders to put boards together sooner. Now that doesn't mean you have to do all the expensive audits and get an independent third-party auditing and blah, blah, blah. But just having the discipline, for example, I have 74 companies in my portfolio, pre-seed portfolio right now. I would say less than 50% of them send me monthly updates, which is an incredibly low percent.
Yes.
But if you had a board that met every month or even once a quarter, you're sort of forced to put stakeholder updates, just simple things like being honest with the shareholders about what's going on in the company. If you have a board and you have some cadence where you have to report to them, then maybe you have to report to everybody else. And frankly, in the early stages, what I've found is the CEOs who do monthly updates and communicate better tend to be the better CEOs. And having a little bit of governance can maybe force that communication and force that self-reflection on a regular basis. And it's not a bad thing. It's a terrible thing when I invest in a company, I don't hear from the CEO for 8 months, and the only question is, I need more money. It's like, well, you haven't told me what the hell you were doing for the last 8 months. Like, how am I supposed to give you money?
And you do have also a blog that speaks about the ideal kind of report, right? Which is actually 1 page.
I mean, what I expect is it should not take you more than an hour to put together. And if you don't have an hour once a month to communicate to your shareholders, there's something really, really wrong with you.
Excellent. So let's still stay on this question. You've been chairman of the board of directors. So talked about what CEOs get out of having a board of directors sooner than later. As chairman, and you've also been in public companies. So what have you seen that is world-class in governance?
What have I seen that's world-class in governance?
Yeah.
I don't know. I could tell you all sorts of stories of dysfunctional governance.
Of course. But the world-class are there term limits? Do you have to bring in certain domain experts? I mean, what is a world-class board of directors? It probably evolves with the business model. There's no right answer, right, Martin?
I don't think there's any right answer. And some of the things that you have to do in the public things, I'm not sure I like. Like, for example, the audit committee must be chaired by a person that's an accountant. So that means you have to get an independent person. And frankly, getting independent board members who don't have any stake in the company, I've seen that be a very bad thing. So I don't know that I would call that world class, or best of class. I think the best boards that I've been on are ones that are, shareholders in the company. I think it's bad for the board to not be shareholders. Preferably shareholders who've written a check versus gotten free shares as an advisor.
Yep.
And that have a bunch of connections that can help the company, and that has a chairman that is truly independent and can be honest about what's really going on in the company, and honest with the CEO if he has to change something. I see captive boards as a poor governance thing.
Yeah, it is an evolving
It's evolving.
topic. It's evolving. Yeah. This last week, so this podcast is being recorded the week of August 5th, 2024, for the record here. So last week there was a landmark Google antitrust verdict.
Yeah.
And I really wanted to take advantage. I lived in Europe for a long time. I love Financial Times. I read The Economist. I read all the financial press, but the title from Financial Times is "Billions of Dollars in Payments That Have Flowed Between the iPhone Maker," right, Apple, and the search giant Google could be at risk. Taking advantage that I have you as my guest, Martin, can you forecast or predict, because there hasn't been kind of the next stage of the verdict, what does Google have to do to demonstrate that they are not a monopoly in the search business, right? To be determined. What would you want to kind of forecast? What may be some logical next steps, and how the sector may evolve?
Well, I'm still a Google shareholder, so maybe I have a dog in this fight. But I think one of the worst things that has happened and continues to happen in the tech business is when the government comes in and tries to help. This ruling is the most backwards, stupid, misread ruling about the antitrust in the world I've ever seen. I think it's a terrible ruling. I hope it gets appealed, because the core of antitrust is the consumer heard? Not is something a monopoly. It's frankly not illegal to be a monopoly. What's illegal is when consumers get hurt. Now, how do consumers get hurt with a free service? It's free. So anyway, we can argue all day about the validity of that. I think what ends up happening is a fairly simple solution, which is what Apple should do is say, we will give consumers a choice on the which one they want to do at the install, and we will pay those vendors will pay us a per install fee for whoever gets installed. So I guarantee you 95% of people will still choose Google. But maybe, Microsoft or Brave or one of these other ones gets paid too. As long as Apple would allow a choice and not an exclusivity, they're probably going to get less money from Google getting paid for install. But I think, and by the way, people can always change it. I think there's a fairly simple fix to become compliant in the antitrust laws. It'll result in some lower revenue to Amazon, but that's okay. They've got how many $200 billion of cash on their balance sheet? They don't need the money. Right. And Google is facing much more. And the funny thing is here we have a ruling about a prior thing, 5 or 6 years ago. But look at what's happened with Perplexity and OpenAI. The real threat to Google search is not whether or not they're on Amazon. It's that AI is going to disrupt. I have switched most of my searches from Google to Perplexity. And the funny thing is, the reason Google has been so great, I don't know if you were around when Google launched, but when Google launched, there were lots of bigger, Yahoo was a bigger search engine,
Yep.
Alta Vista was a bigger search engine. But what happened is that when you went to the Google search box and you typed in your query, the results were 10 times better than Yahoo or Alta Vista. And you switched immediately. They have a better product. It has been a better product for 20 years. They won the share with better product, with a better product. You can argue whether they kept the share with any competitive things, but their product is amazing. And what's happening now is that these integrated AI bots
Yes.
are better products than
Yes.
Google, because Google's model has devolved into basically selling ads and trying to get you to click on buying things.
Right.
And
The advertising
sometimes
revenue.
I just want the answer.
Yeah. Yeah. So the true competitor or upcoming competitors are the Perplexity, right? ChatGPT.
Perplexities,
Yep.
OpenAIs. I
Yep.
mean, and it's all better for consumers, because rather than having to navigate through a bunch of sponsored posts, I can actually get the answer to my query immediately, which is really what you want. That's what you want in search most of the time. You don't really want a link. You don't want to be sold something. You want an answer to a question that you have, and AI gives you the answer.
Right. And the verdict maybe came a little bit too late. I mean, Microsoft was already fined in Europe and had to unbundle, right? So it's giving options to the consumers,
That's
right?
fine.
Right?
Unbundle it. I mean,
Yeah.
all that stuff will solve itself. I'm not worried about it. I'm very excited about the next phase of innovation, which is going to benefit consumers. And, there'll be some disruption. I mean, it's not clear that Google's going to own AI. Look at how they screwed up Bard in the beginning,
Absolutely.
which is,
Yeah.
as an investor, a very exciting time. Changes in the air.
I love it. I love it. So, Martin, I also like to have my guest have an opportunity to talk about how to reach you.
Yeah.
What's the best way
The
in this
best way
meeting?
is to follow me on Twitter, Martin G. Tobias.
Okay.
And on my bio, if you want to pitch me a company, I have a link to where you can pitch me. But I'm most active on Twitter. I do not respond well. I have occasionally to cold emails, but I prefer Twitter.
All right. So
And my blog, of course, is incisive.vc.
right.
You can sign up for the blog and see my investments that I write.
All right. So thank you. Before we go, coming back to the Founder Sandbox, I do like to do a round of questions with each guest on the meaning of resilience,
Okay.
scalable businesses, and purpose-driven businesses. And your own words, please. Resilience. What's resilience mean to you, Martin?
Being able to take a punch and get back up. The founder is a long, hard-term job. And I started investing only in founders who have some kind of resilience practice. Because the problem is not, can you burn the candle at both ends for as long as possible? The problem is, what do you do to reset yourself from the stress? That could be meditation, that could be working out, that could be something. But what I've found is that if founders don't have a way to reset from the stress, to be able to be resilient, to come back from down times, they're not going to make it long as a startup founder. So for me, resilience means having some sort of a practice to be able to reset your stress meter and come
Thank you.
back for another punch, because you're going to get another punch.
Yeah.
And I hope you like punches.
That's right. And that's very practical, what you've just shared here. What about purpose-driven enterprise? Your whole professional career, as you've walked through here for my listeners, it's very purpose-driven, right? Like to be around smart people, solve big problems. You actually have a nonprofit in the environment.
I do. I have a nonprofit called Retree, which helps reforestation. What I found is what I look for in an early CEO is some personal stake in the problem that they're solving, that is going to give them the reserve of purpose, which is an accelerant to this resilience, right? You're going to have a hard time. And what's going to get you through? Well, if you have a purpose instead of just a mercenary type thing, the absolute worst pitch I see is an MBA from Harvard, said he read a Gartner study about this enterprise market, and he wants to create a company in the top right-hand corner because I think the margins are blah, blah, blah. He's done all this fucking analysis and he thinks this is an opportunity. That's a mercenary, right? The mercenary is going to get disheartened by all the problems along the way if it doesn't go the way he wants to, his way his coddled, freaking privileged life has gone his whole life. What I'm looking for is somebody that has a personal stake in something. I just looked at a case management software company for disabled children.
Okay.
Autistic kids and stuff like that. Basically, the software that these field case managers use is old, it's shitty, it's terrible. This guy's his son is autistic. They had a case manager. They had problems getting all the reporting correct, the insurance and all this stuff. He went around and looked for a problem, other companies to buy, couldn't find it, ended up starting the company just because he was so frustrated with the software that he had to use that he had to solve it himself. So he has a personal stake in solving this problem, a personal insight into this problem. Then the question becomes, is he a good software developer and can he build a scalable channel and all this other stuff? But I'm looking for that personal stake in your problem.
Beautiful.
Yeah.
Thank you. And I loved that you shared an example of a founder. Sustainable or scalable growth. You've been through 3 cycles at least. What was that? That the term is called a three-cycle investor.
Yeah. Because, you were there for the dot-com crash in 2000, the great financial crisis in 2008, and then the pandemic in 2020. Sustainable, it goes back to my original thing. I actually have a problem with a lot of these sort of ESG labels or climate things and all of that stuff. I don't think that is sustainable. So a sustainable business is a profitable business. Again, as a CEO, you have one job. Don't run out of money. And it's not sustainable to lose money forever. So, the most sustainable business is a profitable business. Now, if you want to, for marketing reasons or whatever, put a bunch of non-financial metrics around your company, for marketing purposes, that's fine. How much, carbon you want to save or something like that. But you better make sure you have a solid financial, sustainable business. A sustainable business is a profitable business. You have to solve a real problem for a customer who has a budget, who is going to get more value out of paying you than than anything else. For example, I have a company called Vega Cloud. They are in cloud waste management. They help enterprises who have big cloud bills save money on their cloud bill. One of their customers pays them $3 million a year for the software, but they save that company $48 million on their cloud bill. So there is a 17x ROI. That customer is happy paying $3 million a year because they're saving $48 million. If you don't deliver that kind of massive value to your customer, they will not be your customer for long. And you have to do that. That is a sustainable company, is a company that delivers massive value to their customers.
Value-based agreements and it's a pricing, and willingness to pay from customers.
Pricing and willingness to pay. I think this is a giant problem right now, with the general B2B SaaS model, this per seat model, a per seat model that has nothing to do with value. A lot of companies are looking at their SaaS subscription prices and they're squeezing them down. You saw it in the results of companies like Salesforce. Salesforce is having to renegotiate because people are like, why am I paying $1,000 per seat? This guy's not getting the value, blah, blah, blah. There's going to be changes
coming. Yeah, there is a reckoning coming.
There's a reckoning coming that's pivoting more around the value of the software versus the per seat per year model. I think there's a big change coming, and I think that's good because people should only pay for things that deliver value.
Last question, Martin. Did you have fun in the sandbox today?
Yes, I did. I enjoyed this conversation, and I appreciate your bringing attention to governance and sustainability issues for startups.
Thank you, Martin. So, to my listeners, if you like this episode with Martin Tobias, sign up for the monthly release that founders, business owners, corporate directors, investors, and professional service providers go to learn about building strong governance in resilient, scalable, and purpose-driven companies to make profits for good. Signing off. Thank you, Martin, again for joining me.